Welcome to Building Your Business, Sources of Finance. So we'll be talking about finding financial resources, financial planning, creative sources of funding, equity and business angels, venture capitalists, and the role of the pitch. So there are 3 reasons you're going to need finance. You're going to face cash flow challenges. You might have to purchase things, you might have to have training or pay employees. You might need to pay for some marketing or sales generation. You might need some capital investment, which is cost of real estate, facilities, equipment, which might exceed your ability to buy them yourself. You might have some lengthy product development cycles, and you might have some significant upfront costs, which are just beyond your ability to pay. So, what are the typical sources of finance? Well, there's your own money. That's where most firms start. Then there's family and friends. That's asking your friends to invest in your idea. There's bootstrapping, which is getting money from wherever you can, venture capitalists and angel investors. You might have an IPO, an initial public offering. That's selling stock in your firm on major markets. It's complicated and expensive, but it does provide liquid capital to your firm or payback if you're cashing out at that point. Or you might go to commercial banks. It's not viewed as practical to go to the bank and ask for a load of money to run your business, but you never know. So personal funding. Only 10% use external funds in year one. Most firms start off with you, the entrepreneur, funding it themselves. Half of firms don't ever get any money in the first 8 years. You may borrow from banks or have some personal debt, stick things on credit card, that sort of stuff. But basically, it's what we call sweat equity. The value of time and effort put in by the funders to make it work. It's what makes or breaks the firm. And this is, for those of you of a certain age, or if you're a film buff, Debbie Allen fame. Fame costs, and here's where you start paying with sweat. Quite a famous line. Family and friends. Cisco Systems, global IT provider, started in the house of co-founders' parents, and now one of the major firms. 3 rules of thumb: make requests in a business-like manner and describe the risk. If it's a loan, not a gift, write a contract or make some note. Ensure the lender can afford it. I mean, if you're borrowing from family and friends, they'll often agree, but can they really afford it? Are you going to pay it back? Do they really want the money back? Just take care with this. Family and friends and business can be a bad mix because it can damage relationships. Often you'll see dilution, which means as more people invest, their original, maybe they gave you money for half the firm, and by the time you come to sell it, they've got practically nothing because you've got more and more investors. They might lose everything. So it can often put strains on relationships, so be really careful. Bootstrapping, or finding ways other than external finance. It's from the adage, pulling yourself up from your bootstraps, and it's all about doing everything you can to cut corners, cut costs, raise finance. So you might buy used equipment, sell some things, eBay, avoiding expensive, getting advanced payments from clients so they've paid you before you've done things. It's just an adage really that's avoiding spending money but still making progress. Now, can you just ask? This is a great TED Talk. I suggest you pause here. I've put a link above. It's Amanda Palmer, who has a great story about how she financed an album just by asking. It's really insightful. Do stop and watch that. So money from investors. This is typically what people speak about, but as we saw, it is maybe quite a few years down the line. So business angels. These are individuals who invest their own money directly in firms, typically something between 10 and 500,000. They're looking for a large percentage in a growing firm. They may be interested in mentoring as well as return on profit. Business angels often work in groups, invest together to try and look for both mentors and spread risk. So you may see groups of local business angels, particularly looking to support local businesses. Often they may want to get quite involved. Another group is the venture capitalists. They'll invest at all sorts of rounds: seed funding, early investment to develop prototypes, feasibility, startup funding, investment in firms which has a business model and where product development is reasonably complete but production hasn't begun. They might look at first stage funding to help increase production, second stage funding for expansion of either capacity into new markets, or MES financing, which is about further expansion and looking to IPO or buyout funding, and that's funds to acquire the firm. We also talk about Series A, first round after angel investors, and B is second round. So those are the sort of things, the sort of terminology you might came across. But venture capitalists do appear in all those. Typically, VCs will maybe come in post revenue when you've started to make money and they're really looking to grow a firm. So what do investors look for? Well, I've got two case examples. I went and spoke to an early stage investor who's got what we call a clip size, an investment size between 300,000 and 5 million. And then a later stage investor, a venture capitalist, who invests 10 to 50 million typically. So this first example comes from a discussion I had with an investor who works for what's described as an investment company. They don't see themselves as venture capitalists, they see themselves as investors who develop IP. They particularly are interested in early stage equity investments, and their focus is on companies based on highly distinctive and defensible technology, intellectual property. That's where they look to invest. So the typical investment profile they're interested in is pre-revenue startups with technology. So they're into seed stage. They want to be the first institutional investor in. There may have been some angel money there. Seed clip size, 300 to 750 for 20 to 40% stake of the company. So you can see they're really looking for quite a lot of your business. Typical lead Series A is 1 to 5 million. Investing is half to 2 million further, and to bring in other institutions so that they'll invest throughout, and they'll look to follow money in subsequent rounds. So they'll invest early and then they'll look to invest again and again and again if you're hitting their benchmarks. So really they're looking at some runway of funding, and they'll keep following you through and reinvesting and reinvesting. So don't think because somebody's invested you in the first round they won't invest in you again and again. So typical involvement, they always take a director a seat on the board. They provide startups with services, executive search, they'll find other people, they'll help you with admin, which is your bookkeeping, tax, share schemes, pensions, sort of basic legal requirements. They provide some training and development. Total resource support of a day a week with early stage companies is what they're expecting to have to give you. So they're pretty involved. So I asked what the decision factors that the investor made were, and they gave us this list. So first, does the company's proprietary technology offer the potential for a sustainable competitive advantage? So they're looking for deep internal technical expertise to assess this. Often the technology they're looking at is based on new science from universities. Secondly, they asked, do we love the founder and the management team? They said, it's like marrying them at this stage. It can be a 10-year journey. So a lot of the investment here is, do they even like you? So third question, what big problem does the company's technology solve? If they can't find somebody who would buy the company's product, they're not going to invest. It's got to be, as a rule of thumb, 3 times better than incumbent technology. Can the company grow to be worth 100 million plus? what do you need to believe for this company to be valuable in the future? That's a very big question. If you think your business can really generate, this 100 million plus value, does the execution plan make sense? Any early stage plan never survives encounters with the real world. But has the team been able to articulate any sort of sensible route to success? But basically, they're saying, it's going to pivot. They know the business is going to change, but what's the team like, and can they articulate that story to lead them through to a successful conclusion of their business? So things we need to check on the investment. IP due diligence. They're looking for patents. They're looking for how well they're drafted and who owns them. The value proposition on due diligence. What facts and analysis justify the company's claimed benefits for their products? They may need to build or amend the company's techno-economic or other numerical performance, so that they'll do their own modelling. They're not going to trust yours. They're going to talk to potential customers, ask the company who they're talking to, and find out maybe who they're not talking to and why. And then they're going to get references for the leadership, the team. They're going to find out who you are and ask about you. So the things, well, is there lots of financial modelling? At early stages, concerns more whether the company can raise enough money, not run out before they become self-sustaining. So they do lots of cash flow modelling, trying to understand where you're spending your money and where it might come from. They don't use discounted cash flows, but they look at comparables, look at how many sales do you need. They'll also look at firms that might be similar to yours, to understand how that might work. They're valuing at pre-money. Pre-money means the value of your company excluding external investment. Obviously, if you've got wedges of cash coming in from an investor, then the firm is worth that plus whatever else you've got. So that's how they value that. How are portfolios expected to play out? They've got an evergreen portfolio, they call it. They use a company rather than a fund structure. So the way the organisation IP Group's structured is more like a company. So this was, when I spoke to them, they've got 80 odd firms they'd invested with in this particular portfolio, but the top 10 have 70% of value at any one time. So to exit 4 to 10 years from their initial seed money. So this is a group that's in for the long haul. This is an interesting stat. 1 in 4 companies are successful. So achieve the original aim. Others are repurposed or recycled rather than being wound up. So they're not going to throw away the company, but 1 in 4 they would deem successful. Our second investor profile comes from a venture capitalist who works for a large venture capital fund. They've recently raised over £1 billion. They raise from a number of different sources, and then they invest that money, and they seek growth through equity investments. They focus on technology and technology-enabled companies. So, for instance, one of the firms I saw they'd invested in was a clothing company that has a very strong online presence. So it's not just the sort of high tech, it can be clothing as well, but it's that digitally enabled element that they look for. So this is companies with over 20 million in revenue and annual growth rates over 60%. So this is, firms that are established. They look at a minority stake of 10 to 50 million. So they're looking at a seat on the board and to change the management structure, to change the way it's running. And they're looking for at least 3 times the investment in 3 to 5 years. So the decision factors. Does the investment fit with the strategy profile? It's often more subjective than you'd think. So they're really looking at the firm and thinking, does this really fit with what we do? I've seen some of the firms this company's invested in, and they include clothing firms that are very much online and driven by online retail sales. Do we love the founder management team? Again, a key criteria. because they've got to work closely with them for 5 years. They need to trust you. They've got to believe in your vision. Historical financials and KPIs, do those support the story and the projected financials? I mean, that depends on your business model. Typically requires a deep analysis of the customers, competitors, purchase behaviors, cost structures, etc. These investors are very skilled at this, so they're going to look very deeply into that, and they really understand the numbers. They're going to negotiate a deal to get a return on investment, though. The guy said, look, this is an art, it's not a science. There's a lot of stuff written on this, but really it's a lot about experience. So things they need to check: legal due diligence. Are there any impending disasters, lawsuits on the horizon, lawsuits in progress that they know about? Do they really know who owns the company? Often company owner structures can become very convoluted, particularly if you've had a few investment rounds already. So where does that money tie back to? Who's invested? I'm looking closely at the contracts to find out, are they drafted correctly with employees, with suppliers? So when you're buying something, you really understand what it is you're buying. Financial due diligence, are the real numbers the same as what we were told? So they're going to really take the business apart. They're going to look closely at the individuals. Are they crooks? Are they for real? As the guy said, you can really fall in love with crooks. What reputation have they left behind? What's their past history? Are they actually responsible for previous successes or failures? Who are the team? Because obviously they might be trying to invest in a firm, but all the people who really set it up and knew what they were doing might have left. So other pointers, is there lots of financial modelling? Nope. Can't look to past performance to extrapolate any meaningful degree when companies are growing this fast. Success failure for investment is not borderline. If a company is successful, it doesn't matter if you pay a higher price to get the deal. If it fails, you lose all your money no matter what. It's clearly not true for buyouts or distressed firms, but he's talking about these fast growth firms here. So how are these portfolios expected to play out? A significant proportion of investments are expected to fail, 75% maybe, down to 30% in the later stage, but 75% of seed investments they're not expecting to be successful. The aim is to get a good piece of standout companies which become the global successes, and they pay for all these other failures. This is what you've got to think about if you are an entrepreneur. Spread your risk. Don't put all your eggs in one basket. It's not so good for your investors, but if you spread yourself around and you don't know which one's going to become your winner. So what is it like to get investment? Well, I spoke to 2 different firms to get 2 case examples. An early stage firm called School of Everything and a later stage firm called Neul. So School of Everything was a London-based internet startup company that was founded in 2006. The link there. The purpose of School of Everything is to connect people who can teach with people who want to learn. Learners were able to search for teachers in their area, and similarly teachers could search for learners. Registration is free. The site caters for teachers who charge for their lessons and those who offer lessons for free as part of some form of skill swap. It won the UK Catalyst Award for Social Use of Technology, New Statesman New Media Award in 2008. 2010 it was chosen by Vector and Department of Business Innovation and Skills as a platform for adult informal learning. So early doors, it was quite a promising business. So 5 co-founders started the School of Everything. They had the idea but needed capital to make it work and grow it, so they contacted some angel investors. They approached between 15 and 25, and they tried lots of direct contacts, but none of them were willing to be the first to commit. So they had lots of discussions, but they kept asking, well, who else is in? So the team used their network to get some funding. As a finalist for Seed Camp, a competition, they met a particular tech investor who suggested they go to Silicon Valley. The team went to the US for a week and talked to a lot of people and made some connections. And one of the last discussions they had in the last minute, he said, you need to meet this Italian guy who he actually then met in London. So he went all the way over there to be introduced to somebody who said, meet this guy in London. And he was then given £100,000. So, this network, everybody knows everybody right the way across the pond. Mainly EU investors, but they do have connections. So having secured this first 100,000, additional funding was easier to find. Angel investor came forward. A series of them started then investing money. They signed a deal worth £350,000 in 2007, which enabled them to hire and build the website. The round 2 seed funding was sought in 2008, but at that point the stock market had crashed, so it was very difficult to get VC funding. $300,000 was raised from the current group of investors and 3 new ones to keep the firm moving forward. So at the angel level, you never actually need to pitch. In what you might consider the business school context, what you've been doing, it's rare to give it to more than one person. Often you'll find you're sat in a coffee shop, sitting with a laptop. Many investors just want to talk. It's more of a conversation. Really, they're sussing out your idea, because they know the idea is going to change. They're getting a feel for you and your ambition. So the first investor liked the idea, but he was interested in the characters. He didn't see any finance or projections before offering to invest. They had a PowerPoint deck, which is about the big vision, what they wanted to do with the money. They wrote a big fat business plan, but no one saw it. But it is a useful exercise for you to do, to really think it through. So when you're asked questions, you have the answers. You may never show it to anyone, and it's valuable to maybe pull it out later on. So the business plans, which you do, might even put investors off, and they're looking for progress, not hypothetical plans. The quote here that they said is, you might hide the business plans from the angel investors. Really, they're interested in you and your ambition. So the emotion of doing a pitch. So I asked, what's it like to pitch your business? And they said, well, you can meet 20 people and none of them will say no, but they don't say yes. They say, let's stay in touch, which means no. And they said winding yourself up to do this constant pitching can be really tiring. So who goes and how many of you go, you need to play around with that to find out what's your best team. The entrepreneur here said that he found it easier working on his own to get that one-to-one connection, and later on going as a team when you've already developed a connection with somebody. So when School of Everything got the first commitment, it was a surprise. Until then, they didn't think it was real. And then they thought, oh, we've got to be serious, we're going to do this. First round in 2007, the founders got good terms as the market was buoyant. The pitching was relatively easy. 2008, it's all changed. Markets are down, it's more pressurized. 2020, height of the pandemic, markets are in the toilet. But people are looking to make money, so there's always opportunity. So I asked, what's it like to sell part of your firm? And I got an interesting response here. He said didn't care. He had no emotional connection with valuations until they're real. Paper valuations are crazy. People saying their business is worth 10, 20, 30,000 pounds, when really they're not worth anything. The focus was on getting resource to make the idea work, and actually is prepared to give up a good percentage of the firm to make this idea come to life. Different founders have different opinions, and that did cause grief for this particular. So the summary and key learning: School of Everything is a good concept, but it has a flawed business model. It works, they didn't make any money out of it. the relationships with investors remain good, even though they know it's not a cash cow. They didn't lose money, but they lost the opportunity cost. What that means is if they'd invested in somebody else, they might have made more money. But investors are intelligent people. They look at the portfolio. They understood what they were getting into. They learn from it. They may lose money, but they'll see that you've learned, and maybe you've made a relationship for your next business idea. And I like this one: be milestone oriented about fundraising. And actually, this particular entrepreneur said, I wish they'd raised less money to start off with, just 20,000 to test the concept to see if it worked. Maybe divided their plan into chunks to have more staged gate. You hit certain stage gates, certain goals along the way, and you see how you've got. And you can, as he said, you can prove a lot with little money. I very much got the impression that this was a business idea that he liked, but was never going to make any money, and that was just how it was. So Paul Miller was the School of Everything founder, now runs Bethnal Green Ventures. This was back in 2013, this particular slide, when I first spoke to him, and you can see there he was doing twice a year, selecting a group of very early stage companies to invest in them. Now the firm is still going, 8 years of experience, 127 ventures backed, 80 million of follow-on investment in their portfolio. A lot of people employed, a lot of money invested. So clearly this is a successful organization that's run now for quite a number of years. The second firm I'm going to talk you through was an interview I had with one of the guys from Neul. It's a TV white space technology. And what that means is there are gaps, if you will, in the bandwidth around TV, the white space, and you can transmit in those gaps between channels. And these are very long waves. The wavelength is very long, and that gives you very long range wireless connectivity. It's very secure. The devices don't interfere with digital TVs and microphones operating. You get a 10-kilometer range. So if you think about how good your Wi-Fi is, these little boxes go for 10K. You actually have to have fairly large masts. Their equipment allows networks to operate safely and legally within the TV white space spectrum. So their focus is machine-to-machine wireless technology. It's low-cost, long battery life machines. A battery will last 15 years at low bandwidth. So you can use them in smart meters, dustbins, asset tracking, parking spaces, burglar alarms, monitoring on pipes and industrial valves, so say transporting water across long distances or oil. It's not home focused. This is very much business to business, long range industrial technology. So Neul funding, initial rounds. 3 colleges started the firm in 2010 and officially formed in 2011. Initially, some of the founders personally invested around £1 million into it. This was funding they had from a previous successful startup. The first 6 months, the firm was run without any external funding, so they did it internal or friends and family. The second 6 months on the cash came from founders. Summer 2011 Series A, they got 8 million from 4 key funding organisations, and founders also added some money into the mix. Then they got top-up funding in spring 2012, another 2 million from a new investor, a larger investor, and the remainder from previous funders as a top-up. So who do you look for? Well, when Neul started looking for investors, they sought certain attributes: people who brought something to their board, a mix of VCs and corporate investment who bring synergy to the firm, and some longer-term investors. However, their experience was that they went with this utopian hope, and that they would choose investors. In practice, they found it very hard to find any investors, and they weren't selective at all. They basically took whoever offered money. This was a surprise for such a strong team who had a great story. They'd already grown a company. They were based in Cambridge Science Park. They had established relationships with VCs. and they thought this was going to be easy. They'd assumed that they'd get plenty of money. They saw 50 and they got 4 interested people. Actually, 10% of the people you see is quite a good success rate. If you get 10% of people you see as investors, well done you. So the pitch. And now the Neul team are technology leaders, but they're more inclined towards science than business. So what do you tell a VC? Not a lot of science. The pitch is around the idea. Machines should be connected, and here it is. It's difficult to explain ecosystems. It's complicated. Investors who want to will need to understand to invest in it. If they want to understand it, they will. It's hard to explain it in depth. But focus on how and why it works and the detail on how to get there. So this pitch that they had was constantly rewritten, but very little financial details provided. They had estimates of salary, revenue. Most VCs like to do the financial model themselves. What don't you tell them? Well, little information on finance or the exit strategy. Worst case outcome around the regulation and getting white space spectrum wasn't discussed. Underplaying marketing need, though probably that was done naively because this is the sort of tech that needed more marketing. So I asked, what's it like to pitch your business? The first time it's exciting. By the 50th it was boring because it's the same thing, same questions. But they had to keep it fresh because they kept doing it, and they, basically had to get other people in to do it, not to try and do 4 or 5. So you've got to keep that enthusiasm, not rock up to an investor who could be the one and be bored by your own idea. So I asked, what's it like to sell part of your firm? It didn't feel like they're parting with the idea. VCs aren't asking you to compromise your idea, only part with your shares. You've got nothing to start with, so it doesn't feel bad. Their vision was it would grow very big, and so you want a smaller part of a large pie, and it's necessary to make as much value as possible. So they had a plan to seek Series B funding. 10 million was sought. As more finance was given, the more resource could be deployed and the faster the firm could achieve its goals. Current investors wanted to defer this funding round as long as possible. As the firm passes more milestones, the more the firm is worth. So they were trying to defer this Series B. There was a tension there against firm value versus firm goals. So, do we get more money in so the firm is able to progress, or do we wait until we've passed more milestones so the firm's worth more so we get more money in, if you see what I mean? So this is an obvious tension. So what happened? Well, Neul was a 30-person company, and it was actually bought by Huawei for a reported 25 million in September 2014. So you can do the maths there. They did quite well out of that. So lessons. Venture capitalists like to do their own financial models. Investors are looking for people they trust and their track record. The focus is on making return from the investment. You have a great idea, but will it make money? That's what they're looking for. When pitching, keep it simple. What's your story? Why is what you're doing interesting and new? What do you own? What money are you going to earn? And when are you going to earn it? And who is your customer? So when you're looking at your pitch, think of your idea and work out your pitch. Who are you pitching to? What is your core message? What's your proposition? What do you want? And why is it a good thing? And I guess most of all, stay ambitious, stay positive, and really be energetic and enthusiastic about your idea, because if you're not, you can't expect somebody else to be. So as acknowledgement, I'd like to thank our venture capital fund managers and investors for giving us insight into the life of VC and investors. I'd like to thank William Webb from Neul and Paul Miller from School of Everything for sharing their experience of what it was like when they started those firms and started raising money. Finally, Louise Marston, who was at the time leading from Nesta, provided help in identifying and contacting different individuals for whom we could learn. As a side note, I'm part of this too. I've started a firm, hubofallthings.com. You can look at that. It's recently rebranded. It's got a new management team. I'm not part of it anymore, but it's now called dataswift.io. It's into third round funding as we speak, and hopefully we'll go on to great things. You can look at that as well.